All right. Welcome everyone to our latest Ag Economy Index report. This time talking about the first quarter of 2025. The survey was conducted in March, and we're here to talk about some of the results and bring you some of our perspectives and insights. So to start, let's look at the overall industry and how it fared out in March. And we had the lowest index across our entire project since we started in October 2023. We had an index of 82, which again came down 8 points lower than 12 points lower than what we found in December 2024. And this was driven by 4 of our 6 segments, which we're going to explore later, going down: input manufacturing, agricultural production, processing and handling, and support services and products all had their indexes going down, and 2 segments actually going up: input distribution and food manufacturing. I think one thing that is important to mention here is that our current index, which measures how people are perceiving their segment and their companies today, still went down, but not nearly as much as our future index that went down quite a bit, 20 points. Now they're almost at the same level, 82 and 81 points. Alan, how do you see that change from December towards March? Last time we talked a lot about uncertainty regarding elections and how things were shaping up, and now we see, a decline once again in overall sentiment.
Well, I think in some ways, I think, Lorval, we probably would have predicted this coming into that March survey. We knew coming out of the December survey that there was this sort of natural bias towards a positive reflection of maybe a change in administration across the industry. We saw a little bit of a bump in that December survey. But we really kind of went back on what I would consider probably a trend since June of 24, where we're really sort of seeing this overall decline in sentiment towards a more pessimistic view of where we are in the industry as a whole. That we were at 105 in June. That's our second highest we ever had seen. And since then, we've been pretty much on the decline, save the bump that we saw in December, which was probably a reflection of an election time period. Now, coming out of that election, we go into March. We've seen a lot of turmoil with a lot of changes taking place in a very rapid time period, which has pushed us back into this sort of what appears to be a more difficult time period. A reflection of this pretty pessimistic view of the future is really what's driving. I think the overall industry outcome is that a fair amount of people see a lot of uncertainty about where the future's headed.
Yeah, that's great. And we have some other questions that we explored, some of the reasons why those could be potentially pushing sentiment down. Let's now explore our industry segments, starting by ag input manufacturing. So ag input manufacturing went down 5 points in overall index. Wasn't that stark of a change. But what is interesting is that it remained stable on the current index at 96, but it did go down 12 points on looking towards the future. That was an interesting dynamic because when you look at the individual questions that compose the index, only one question didn't have a lower index compared to December, which was making large investments, which did go up, but not by a lot. And that's why we see this fairly low change, but still going down. What do you think could be impacting that, Alan? And how do you see, this sort of dynamic? We were going down since April 2024 until August. Then we had a little bit of a bump in December. Then we went back to almost the same level as we saw in August.
Yeah, I think agricultural input manufacturing has been under quite a bit of pressure here for really more than a year. They showed some positive sentiments a couple of times in our survey, but mostly they've been pessimistic. Probably the most pessimistic segment of all of our segments that we pursue in across a long period of time, and with this downtrend in impacts. What we had seen was really sort of coming out of June into August, we started to see some relative improvement in input manufacturing from the current period perspective, working out of some inventory issues, some things really still kind of held over from COVID, really starting to see some improvement in agricultural in these input manufacturing segments. But what's happened is the future outlook has really become pessimistic. And in fact, really in March was a dramatic shift there from a 97 on the future, which is still somewhat just slightly pessimistic, right? Less than 100 to an 85, which is a huge drop off. And that's what's driving now our sort of overall sentiment being somewhat pessimistic is for for input manufacturers, just too much of their raw ingredients are imports. And so import tariffs have a really big impact on things like input manufacturing, which can draw their future sentiment. You know, we're in March, not sure where we're going with all this tariff activity, really kind of drives where they see the future of their segment going, because it's both cost orientation, but also supply, just their supply chain disruption can be really significant for this industry when you have these kinds of sort of restructurings of the trade paradigms that we see going on right now.
Yeah, I agree a lot. And there's one thing that is very clear is that they're not seeing major changes today, but the uncertainty of how things could shape up in the future, you know, what tariffs or changes in policy will take place is something that is clearly sending a very strong signal in that part of the value chain. Okay, so moving forward to the next step of the value chain, the next segment, so agricultural input distribution. This is a very interesting segment. It's the one of the two that actually saw an increase in index, and it's the only one that has been seeing steady growth in sentiment since the low of August of 76. We reached 88. A 16-point increase since December, which also saw a 16-point increase since August, and it's going up. It is mostly driven by current index perception, so they're thinking that today is looking good, and the future index is actually going down, but not a lot, just 2 points. So this is a segment that is behaving a little bit different from the rest of the value chain. It is the only one that has been seeing growth since August last year. Why do you think that is happening, Adam? What do you think is driving such a difference in behavior from this particular part of the segment, or the value chain? I'm sorry.
A lot of this segment is driven by agricultural inputs that are variable inputs, seed, fertilizer, chemicals, things of that nature is mostly what drives this segment. And my suspicion, Lorval, is that some of this is seasonal. So what the high demand for these activities happens in the spring. And so sentiment tends to build up as spring comes, as planting comes, as we start to move into that section where we're moving products, where we're doing what retailers do, which is we're solving problems. There are challenges going on. We got planting, we got to get fertilizer, we got to get lime on, we got to get planting in the fields, all these things are happening, and that's where a retailer really shines because they're problem solvers. And as you get into that sort of August period, I mean, the crop is done, we're finished growing, we're into the harvesting period, and that's the lower period for ag retail. So part of me thinks that a little bit of this is a seasonality activity where they feel improvement because their value proposition is there, right? The unique thing about ag input distribution is that every year, regardless of what interest rates are or what tariffs might be, we have to plant the crop, right? And planting the crop, the input distribution folks are the ones who are primarily there working directly with the farmer to get this sort of stuff done. So I suspect some of this improvement is probably a seasonality related activity. Nonetheless, what I would argue is that it's still pessimistic. I mean, 88 relative to 100 is still pretty low. So the industry really felt some bad vibes, if you will, back last August, and the recovery from those really bad vibes. That 76 overall, or actually the current index was a 69. Wow, that's really low, right? So the industry was really feeling some bad pressure last August. So we're seeing some improvement in that, despite the fact that the ag industry overall is probably a bit depressed. Crop commodity prices are down. We're seeing some improvement here. I suspect some of that's probably seasonality oriented, but also coming off a really low period in August.
Mm-hmm. You know, it's interesting because I had a conversation with a farmer a few weeks ago, and what they were telling me is that because they weren't sure of how commodity prices or input prices were going to look like in the next weeks or months, they were buying everything that they needed for the entire year right now because they know what the situation is today and they know they can do well with what is happening today. So that might be something that is happening with ag retailers where a lot of their customers saying, hey, let's close everything that we need to close with prices as they are today so I don't have to worry about the rest of the year. That might be something that is making ag input retailers, hit their goals and do well this year, at least up to this point. So now, agricultural production, one of the most important segments in our value chain. It had a major dip in August compared to June last year. It bounced back in December, going back to 101, and now it went down a little bit. Not much. It went down from 101 to 94 points, so just 7-point difference. And this is the only segment where, even though future index did go down more than the current index, they're still very close to each other. They flipped, but they're still very close. Other segments, they have a larger gap between future and current perceptions. This is a little bit different for farmers. What it's interesting to mention as well here, this is the only or in this group, the only question within the 5 questions that we asked that did go up, but it did go up quite a bit, was do you think now is a good time to make a large investment? Being acquiring a big piece of machinery, acquiring a new building, acquiring land, and that was the question that actually pulled the index to be where they are, because the other questions were actually a lot lower than this one. So a lot of dynamics playing here, Alan. What do you think are the major driving forces for farmers to behave the way they are? There's still an overall downward trend, but it is less perceived than other parts of the value chain.
Yeah, I think there's a number of things come to mind for me here. I think, one of the issues is, we have a fair amount of survey respondents who are in the livestock side of the industry, and protein's a pretty good space to be in right now. Relatively speaking, protein's not a bad space, livestock side. So that's, I think, helping kind of level us out in the production index relative to some of the others. I think that's part of the explanation. The other part of it is whether you want to consider this segment to be resilient or have a complete lack of control, right? You can think about it either way. It's a resilient side of the industry, or it's has a complete lack of control. When you think about other parts of the industry, let's say, for example, ag inputs, or we're going to go to processing here in a few minutes, or even to food manufacturing. In those spaces, tariffs and interest rates cause you to change your decision making, sometimes maybe relatively significantly. Maybe where you're going to get your supplies from, or even in some cases where you may do your production, where you're going to source your supplies from. in farming, you don't get that option. Your production plant is where it is. It's in the center of the country. It's going to be in the center of the country. Where you're going to buy your inputs from, you don't get to say, well, I'm going to shift from buying in China to buying in Israel. Right? Fertilizer can do that, but you can't do that in production agriculture. You have to. You are where you are. So these factors that we see having impacts on other parts of our industry's indices don't have the same impact on production agriculture because they can't control it anyway, right? They have to do what they have to do. They have to make the tariffs are what they are. I still am going to choose to produce corn and soybeans, right? So I think it's sort of a combination of two things. We've got an animal protein side that's not nearly as bad right now. It's improving from where it used to be relative to the crop side of the industry. And then the second thing is all the volatility that we expect to see having impacts on our industry, it's going to have less impact on this side of the industry because it can't do anything about it anyway. Those are the sort of things that make me think about why this index looks the way it does. Still, somewhat pessimistic, but maybe not as pessimistic as we might have on the surface thought. Well, surely it's going to be really pessimistic.
Yeah, no, for sure. Farmers overall, they're showing a lot more resiliency to those major impacts we're seeing right now, at least when compared to the other parts of the value chain. Agricultural product processing and handling, that's one segment that saw a sharp decline in index, going from 110 to 81. Both current and future situations looking pretty dismal. The sentiment is pretty bad, Alan, here. We can point to many different things, but the end message is that they're not looking very positively to the future or to what is going to happen, in the near term. I feel like there are major things that we're going to discuss in our thematic questions that are pointing to this, but overall, the uncertainty around tariffs and policies may be a big barrier here. What do you think?
Yeah, for sure. On the side of our, this is a complicated segment for us, right? It has grain handling, it has grain processing, it has proteins and meat processing. They're all sort of encompassed into this segment, and it's a complicated segment from that perspective. I think there's a couple of things going on. Certainly, a fair amount of this is going to be trade-oriented activity. And so tariff policies are going to have a really big impact on the way this side of the industry looks at things. And that's whether you're talking about the grain trade side or the protein trade side, where we still have significant amount of export activity, and the retaliatory tariffs that may be put in place really impact both parts of that segment. You combine that with on the protein side, on the meat protein side, animal protein side, costs are going up, right? Because actually we're coming out of periods with inventory reductions where we had some tough prices in the hog market and tough prices in the beef cattle market, reducing overall inventories. Well, if I'm in the product processing and handling side of this, that's my input. And that input price is going up, causing my costs to go up. Meanwhile, at the same time, I have these concerns about what might happen to my exports. So between those two pieces, whereas in production agriculture, we kind of have livestock offsetting the crop side and maybe keeping us a bit resilient across production agriculture, here, both of them, I think, are feeling the pressure of both the tariff situation and the economics of the situations, driving both of them to be pretty negative. Both in current index. I mean, the current index really went down a lot, right? From a positive perception of 107 all the way down to 74. Certainly, crush margins, for example, went way down in the soybean side, as we see a shift in policy, maybe away from some of the clean energy fuel types of stuff that was driving a lot of our crush margin activities. That's having impacts on that side of it, as well as if I'm trying to export product and suddenly I'm in situations where the whole supply chain is being disrupted, this can be a big impact on us even in the short run here, as we see that current index really taking a hit.
Yeah, this is one of those things that if you're dealing with companies in this segment of the value chain right now, you got to keep in mind when you have conversations that is top of mind for them, and they're not in the they don't have the best perspective of the industry in their segment, in at least for now. Food manufacturing. Now, this is interesting because it's a very volatile segment. It has been, because of this being that close to the consumer. Every major or even minimal change with consumer behavior, it impacts them dramatically, and that causes ripples in the value chain. But it all starts here, so they get the biggest hit. And now we're seeing a uptick on sentiment, which is interesting. Going, from 86 to 93 is not a major growth, but it is an interesting growth. But what is actually very interesting here is the growth in current index. Now, it is important to keep in mind, we're starting with a very low number. We hit 68 in August. It's a very low number. Went up to 75 in December, and now we're at 100 in March. Still a 25-point increase is something very interesting. But on the other side, we had a 20-point decrease on the future index. Basically, what they're saying is that we're doing okay right now, but in the next 1 to 5 years, I don't think we're going to be doing as well. Very interesting dynamic here, and it draws our attention, especially when we compare behaviors on current and future indices.
Yeah, I think what you're seeing here, my sense is what we're seeing here is pricing pressure decline. So inflation reductions have helped with food costs. That's good in the short run with respect to demand for foods. I think that's partly what we're seeing from food manufacturing segment, is this current index being a reflection of some of the inflationary pressures are declining, and that's helping in the short run. But the big drop in the future then is this perception that, one, inflation may be coming back, but two, probably a bigger reflection of overall concerns about the economic growth of the future, which is going to help drive that food demand, being a slower expectations of slower economic growth in the future, really pushing down that future sentiment of like you said, where we see in the next 1 to 5 years. This was setting up to be a really huge positive impact for food manufacturing as they started to see that recovery in short-term demand. Had the long-term situation looked better, you might have seen a really big increase in sentiment here for food manufacturing. But that current condition of sort of lower inflation has been offset now by this expectation that economic growth is likely to be slower in the future.
Another interesting point that may be impacting here is the changes in policy as far as what food has can contain or not, like the food dyes conversation that we're having, the healthy, nutritious food movement that we're also seeing. That can be a great opportunity for the food manufacturing segment, but also it can be a major change in the way they process food, the way they sell food. So that might incur in changes in production plants and marketing campaigns. And that level of uncertainty, even though it can be positive or negative in the long term, is something that is making our respondents feel like, all right, we don't know what the future is going to look like. Potentially, that is a driver for that future sentiment to come down.
Yeah, I think for sure policy uncertainty certainly has, particularly because we have some real attention in policy right now on food itself, can have a real impact on the way they foresee what the future might look like.
Now our last segment on the value chain, the support services and products. So support services and products encompasses all the other companies that allow the value chain to function. So think about financial institutions, think about research institutions, think about market research institutions, think about logistics, right? But they don't hold ownership of the product being produced. So they're there to make sure that the whole value chain in the industry is a well-oiled machine. And this is one that drew my attention when we were running the analysis and saw the results, because it has been a very steady and low and slow decrease in index. and it's by far the least volatile segment of the value chain. But for the first time, we saw a major increase. It was the biggest one we saw since the beginning of our project in October 23, going down 7 points from, I'm sorry, 13 points from 95 to 82. So we never seen anything quite like this before. And that has shown, as we've seen in other parts of the value chain, a major drop in future perceptions, going down 18 points, and a little bit less, but still a decrease in current index situation from 90 to 83. It feels like the financials, the research institutions, they're feeling a little bit of the squeeze right now, and feeling like even though they're in the picks and shovels part of the value chain, some of those macroeconomical forces are starting to hit them.
Yeah, I think this is the segment that probably more than anything else reflects sort of macroeconomic conditions, but macroeconomic conditions in more of a kind of a long-term view of things, it feels like, right? Which is one reason why it tends to be more stable. It doesn't bounce around quite as much. And so I think it's a pretty clear reflection that from a macro perspective that on the industry, they see the macro variables, kind of all of them at once, going negative on us and really having a big impact on the industry. So certainly that future index looks like all the volatility that we see going on really impacting the way they think, because they had this pretty positive view really last quarter in December. But really fell off sharply in March with significant pessimism about where the future might be, along with a continuing decline in current conditions, which I suspect is mostly just a reflection of the overall deterioration in the economics of the industry as a whole, which is going to affect financing. Can be good for financing in the sense that it can create more demand for capital to finance through more difficult times, but also leads to difficulty in collections and potential for higher risk with respect to default on loans and things of that nature, whether we're talking about this at the production ag level or any one of the agribusiness segments in there. Or even in our logistics, where we start to see the impact here, maybe that there's just less movement of product, right, over time, and that can impact us in both of these parts of that segment. So it's been generally going down for a while. Since December of 23, we've generally seen this industry's sentiment continuing to decline here as we come out of those really high sort of periods back in December of 23. See an industry that's macro conditions are just continuing to decline. Combine that with the volatility that we now see during this period of time, and we've got a really suddenly pretty negative sentiment from this segment.